Hi, you're watching Investor Insights, and in this video I want to tell you that all is not lost. I've been frequently talking about the housing bubble, I've been talking about the stock market bubble, and I've certainly been talking about this bond market bubble. When the crap hits the fan, a lot of money is going to be lost. A lot of people are going to be wiped out. A lot of their savings, their investment portfolios, a lot of their hard-earned money, man, it's going to be flushed down the toilet. I'm not a doomsday prophet. I say this over and over again. I'm just a realist. I see something, I work it out, and I tell people about it. And this is a very slow-moving train wreck, but you can see it coming. And you should have been able to see it a long time ago. So, if you're invested in this market, let's say the bond market, you'd be down a little bit. It just depends on your timing. But if you invested in bonds quite a while ago, you should be up, you should take your money, you should run. If you're in the stock market, it's safer to get out now than to wait until this thing implodes. Because I'd rather take small, average gains rather than huge, monstrous losses. With real estate, unfortunately, if you've bought a house at the top of the cycle or nearing the top of the cycle, and it's your primary place of residence, you can't do anything about it. You can't sell up and leave. But if you're looking to speculate into the housing market as a rental property, you should stay the hell away. You may be getting some good mortgage rates right now, but that's not going to last. The government's going to do everything to lie about the CPI so that the RBA can keep rates low, but there's only so much that they can do. I constantly talk about oil prices and petrol prices. You can't tell me that inflation is 2% odd when petrol is up easily 15%. I can't think of any more blatant lies than the central banks and the government's attempt to hide inflation. They do a lot of bad stuff, but I suppose it's okay because they write the rules. I don't want people to lose money, quite on the contrary, because when my people make money, I make money. And I like to see people make money. It's a good feeling to know that your investment methodology, your mentality, your commitment, and all that education that you've spent money on is paying off. Because there's no greater satisfaction than watching your hard-earned money turn around and make money for you. Now, as I said before, all is not lost. With every single disaster comes a whole world of opportunities. And that's both on the downside and the upside. I can't tell you when these things are going to happen, but when they happen, you should be ready for them. When things start to fall and all support levels just get sliced through like a knife through a hot knife through butter, you should be ready to start shorting. You should either look to short indexes, you should be looking to short stocks, specific companies. Companies like Netflix, just for argument's sake, 300 times earnings, man, that's the easiest short out there. And the people who are holding it are just a whole bunch of lemmings. And when they start fleeing, that stock's going to go back basically to nothing. Because its intrinsic value is nothing. The only people that made money out of that company are people that probably shipped that on the IPO. On the downside, you're going to short things. You're going to short currencies. You're going to short commodities. You're going to short everything that you could possibly short. When the market's collapsing, you do it, and you do it with confidence, because the next collapse is going to be the biggest one yet. If you're a long-term investor, if you're a value investor, you just have to bide your time. Now is certainly not the time to get in, but the time will come when things implode and there's blood on the streets, and a lot of good companies are going to be taken down with the bad, and even a good company is badly priced when people speculate too much on it and bid the stock up too much. So just because a company is good doesn't mean it's a buy. Just because a stock price is high doesn't mean a company is good. But lemmings out there will tell you that if a stock is highly priced, it's because it's good. It's got a lot of growth in it. It has a lot of margin for error. It's got great management. What the hell with it? Because that's a lemming mentality. They heard it from somewhere and they're just repeating it. They saw something on Bloomberg or CNBC and they're just repeating it out loud. And they don't realize that those financial channels are full of financial lemmings. They just rehash the same rubbish day in, day out. I stopped watching it a long time ago. I just can't be bothered. Every day you hear the same thing. So, as a value investor, as a long-term investor, you wait. Your time will come and you're going to have a lot of good companies out there at bargain prices. And the time to get in is when everybody's getting out, and you have to trust your insights on those companies. Because the biggest monies to be made is doing the opposite of what the market does, provided that your thesis is correct. That's what you call contrarian investing. So when there's all sorts of frenzy out there, and there's a lot of frothiness in the market, it's overheated like mad, everybody's jumping in. Your taxi driver, the butcher, school teachers, janitors are giving you stock market tips. That's when you get the hell up. But when stock markets hit the news, the front page of the newspaper, top line on Google News, for all the wrong reasons, markets hitting 3-year lows, so forth, company hitting 10-year lows, that's when you get in. But as I've said before, the caveat on that one is that you must have done very careful research on the stocks that you're about to buy, because there may be some more downside. You can't pick bottoms, you can't pick tops, but you got to learn to take a stand at some point. I've given specific examples over the past, and if I was to recall one, I remember ANZ back in 2008, back in October, going I think to about $11 odd. Now at the time, that stock was paying $1.92 in dividends, fully franked dividends. Now, it doesn't take a genius to work out that the yield was approaching, 18%. This is a stock that if you got in, and even if they cut the dividend somewhat, you're still going to be paid to wait 10-15% a year, just on income alone. Now the stock was trading at 11 odd, talking 11.30, 11.40. I didn't care about the downside. You just get in and wait. The stock bottomed, I think, at about 1070 or 1080. So you may have lost another 5 or 6% on the downside once you got in at 11 odd. But the stock sits near $30 today. This is 5 years later. And if you had got in at 11 and the dividends now have been increased since then you've been looking at basically a 20% dividend payout every year for the past year. The past 5 years, sorry. So simple maths will tell you, you've made all of your money back on your original investment in dividends alone. And the bonus was the fact that the stock has almost tripled. So therefore, you've made 200% on your investment in capital gains, and you've made another 100% on dividends. That's a 300% return. Every 100 grand you put in, you're going to take out 400, of which 300 is profit. That's a nice payout for 5 years. And this is what I mean by taking a stand. You've got to understand that the market can be mispriced at times, especially today, but there's always opportunities out there. You just got to bide your time. And I don't care if you're a trader or a long-term investor, there'll always be a trade out there for you. There's always a means to make money in all types of markets.